Gerard, hello, Savannah. Hope you all are doing well. As always, got a lot to cover today. Looking forward to it. Get started here in just 1 minute. All right, all right. Hey, Doug, welcome.
Good
And
morning.
yes, I will be talking about the income machine more and more. I'm obviously very excited about that. Um, pretty pretty excited about that project. Actually got basically the final piece of the data feed in there yesterday, so it does some really cool stuff, and I'll be demoing that and showing you all about it as we go along. Um, Probably, I don't know. I mean, timelines are always tough because there's still some development things, and like I mentioned, I am working on kind of a backdoor plan to do a free access version of it, which is always more work than it sounds when it gets into you know, the system side of things. Morning, JD. How are you?
Good morning. Good morning. Good morning.
How are things in the Midwest?
Well, it's a bright and early, cool, sunny morning. So we're trying to warm up here, but it's always hit and miss in May.
Yeah, yeah. It has actually been mostly pretty warm here for the last couple weeks. Kind of got like a full break of the weather, but then we got hit with tons of rain. Which is kind of, I guess I can't expect anything different around this time here in the Northeast, but lots of rain, and now I'm hoping we just kind of get into that, later May, June, where it's not going to be 85, but it's going to be 75, and still, not raining every day. That's the goal. Um, but hope everyone's doing well. Let's get started because we got a quite a bit to cover, including some sneak peeks on some stuff that JD and I are working on, which I'm pretty excited about. You guys have probably heard me hint about a couple of those things. So we'll do a little more hinting today, but then we're gonna get into the nuts and bolts of something a little bit different, what JD calls the money fortress. By the way, basically how it's going to work. I'm going to cover some material that I have today. A couple things I want to get through pretty quick. Then I'm going to have Jamie talk about, this whole money fortress idea, how it works and all of that. And I'll kind of interview him. It'll maybe feel like more like a podcast than a presentation, maybe, just depending on how things go. But I also want to encourage all of you to be interactive in the chat. Ask questions. How does this work for, certain account sizes, or what do you look at, or whatever the case may be. The point of opening Playbook is to be meat and potatoes, value forward, give you guys good stuff that you can take that's actually actionable for your trading and for your lives. And so this is a good opportunity to do that because this is a less quote unquote scripted training and more of a open ended. James is going to teach something that he's been really developing for decades, and try to give you as much value in that as possible. So that's what we have to look forward to today. And I just want to encourage you to, ask questions. And if you have things that, pop up during the presentation, the chat panel is open to you. Okay. With that said, let's jump in just to kind of cover our bases here. This is the S&P overview that I shared yesterday. Folks, I'm going to keep reminding you of this because kind of like the insider buying, which I'll remind you of in a couple of slides. Uh, I think we're in some of these kind of congested no man's land zones right now. And I just want you to be mindful. If we get bounces in between here, I don't think it's going to mean a whole lot until we really stabilize and move either clearly above, I would say 570, or clearly below 550. I think that $20 range right now on the S&P, about 4%. It's pretty congested. This was a clear bottom when it looked like we were rallying back up in March. If you guys remember, a lot of folks thought we were heading back to all-time highs in March when we kind of bottomed out here and had a really nice pop back above 570. Trump had other ideas. We kind of spun back down, ended right up at that same base. I think this was like April, or no, this would have been like March 30. Same exact level. Started trying to make a move. This was the April 2nd Liberation Day gap. Then we had this pop right back into the bottom of this range on the April 9th 12% move in the NASDAQ. So this is clearly a very real level, right in this 548, 550 area. At the same time, I think we've got some congestion to work through for potential upside. So I'm going to keep showing you this because I think a lot of times where traders struggle is in these congested zones where the market's choppy. They kind of get stuck in a day by day momentum, but in reality, the market's figuring itself out in these areas. So just be careful there. One thing I want to draw your attention to is we're starting to get some pretty decent sector separation. This is just this week so far. And if you guys have been following just, what the sectors have been doing for the last couple of months, they've generally run more together. Now, obviously, that's an overgeneralization because we've had energy and other things kind of fall out of bed some days and stuff like that. But in general, big down days, the sectors have kind of fallen together. Big up days, for the most part, liquidity has pushed everything up. We're starting to get some separation on a more normalized basis. Communications and utilities, by the way, two sectors that the income machine had trades on. So go income machine, really doing well. And we're not talking about 4% crazy gaps, we're talking about just kind of grinding higher. XLP, XLF, XLI, XLY, all these sectors kind of in the middle, kind of 0%ing, grinding along. And then healthcare for the last couple of days has really weakened. Now, I wouldn't take a whole lot of impact on the fact that healthcare is down because you've got Eli Lilly that was down 14%, dragging the entire XLV sector down. So I'm not saying, hey guys, we started a new trend on healthcare. I'm just saying we're starting to get some more separation here, which is not super uncommon for earnings season, right? Because you do have those big beats and things separate, but just something to watch that we might get a more of a rotation here. I think that we're going to get a rotation back into energy. I'm actually fairly bullish. Now, I say again with a grain of salt because energy is not a sector that I look at and say, we're going to have amazing upside in it, except for maybe nuclear. But I think that we're going to get some rotational money moving into energy. I don't mind holding some of the dividend stocks that I have in energy and waiting for that to happen. And I think it has been overbeaten. So just keep an eye on some of the transitional rotations into these different sectors. I still like consumer staples. I still like utilities. But I think, if we get a move above that key level around 570 the SPY and we make a move toward all-time highs, which, some people are very pessimistic about that. Some people are very optimistic about that. But if we get that move, it's probably going to be driven by technology. Let's not kid ourselves. We're probably going to need the tech sector and the mega caps to lead that move if we get it. All right. Quick question. Did anyone take the T-Mobile trade that we talked about last week? We looked at T-Mobile after a big drop down on earnings into the 228 range. JD was actually on that show when we talked about it. This has been a beast. And the reason I'm highlighting it for you today is because it was on. Whoa, I tried to pull up my pen and I pulled up a website. Hold on. Let's try that again. It was on my list already midweek here after we got some follow through. But the reason I called it to your attention is because JD actually called it right here. And as our special guest, I feel it's only appropriate to honor him in that way. That he called it actually even a lower, kind of even at the early part of this day when it was about $232 a share, maybe. You can correct me if I'm wrong, JD, but somewhere in that very early range of this bar. And it is now 252. So we've made a 10% move on T-Mobile. And what was your, sorry, I should have pulled up your Slack. You said, I think we have an easy 7 to 8% move here. I think was your, am I doing you justice,
Yep,
JD?
yep. I actually got members in at 237.34, and at current prices, we're up already 6.5% here.
Okay, perfect.
And that's the underlying stock.
6.5%. I did a little option math. Shocker, it's good. close to 100% gain already on the options in about 5 days. Now, what we've been working on, again, today's session is going to be about something different. We're going to go into meat and potatoes here in a moment. But what you'll see on this T-Mobile chart at the bottom here is actually proprietary to Jamie. These green diamonds that you see here,
And you can see on my screen here, I have
and we have our green diamonds to represent, which you'll hear more about this as well this weekend. It's a whole thing, guys. We're in the Green Diamond Club. It's a whole thing. It'll make sense very soon to you, but it's because of these things on the chart. Now, guys, I'm not going to do a whole lecture on these today. I'm gonna stop myself from doing that, even though it's really cool. But what I want you to know, and what we'll talk about here very shortly, is, and by shortly I mean like Monday, not like today, uh, is that these green diamonds are not just an indicator. Um, if they were just an indicator, they'd be very cool. But there's a whole backstory behind why these are very different than really anything else you typically would see on a chart. And we're gonna get into that. But for right now, I want you to know, if you would have traded the last two on T-Mobile, you would have had like back-to-back triple-digit winners on T-Mobile just following that Jamie called early. And he's not just talked, like he said. He actually issued an official alert on T-Mobile at about 2:37. So really cool here. Now, a couple of the stocks that are on that same watch list that JD mentioned yesterday, and I actually took the liberty of stealing one of them and giving a free trade out here in a moment. But we've got Tyson, we've got DTS, Gilead Science, which is actually one that I'm holding right now, and I like the upside of GILD. As you guys know, I'm a little cautious on healthcare stuff right now, especially the big boys like NVO and LLY. But some of the mid-range ones I actually quite like. Again, I think they're overbeaten down probably right now. And so GILD is one that I quite like. PPC, which uh, this is probably a stock that you guys haven't traded. I haven't traded it either, but on Monday, you'll see one of the coolest examples of a trade ever on this ticker as well, that JD traded previously. But it's back on the watch list right now, so keep an eye
actually
on.
we own it in the portfolio, so we jumped in on May 5th, Nate.
Okay, so already in the portfolio. This is a very interesting stock, but the reason I want to draw your attention to TDS is because, ba-da-ba, green diamond alert, green diamond alert. It's right there from yesterday. And so this is a really interesting trade, not just because it's a stock that I've never traded, but because if you look at the last couple diamonds on this same ticker, well, once again, you would have done really, really good on TDS. This one, was a several 100% move on the options. I think it was like ended up, if you got to the peaks, which we wouldn't get to the peaks, but imagine you did, it's like a 30% move in the stock. This was like a 20% move in the stock. And so if you take this one and you just take a very conservative approach and say, like, if it gets up to, 36, 37, you can 7, 8, 10% on the stock, even just on a small move on TDS. So like I said, because I have access to JD's stuff, I can now steal trades out from under him, which is what I have done here on TDS. And so two different plays you can make. I'll throw them in the chat for you. Let me add TDS to the actual
While
chat.
you're
So,
doing that, if I can chime in real quick, one of the things Nate teased it a little bit, but the green diamond is a combo platter buffet style indicator, and one of the components it has to do with the underlying fundamentals and something we call highly rated stocks, and on a various number of different levels. TDS really is interesting. I don't have this in our portfolio mainly because we're already trading T-Mobile, and diversification purposes, I don't like to get too concentrated in my trades, Nathan. So, but TDS is super interesting in this current environment. When you highlighted the SPX earlier, I think you noted some of the risks involved in this market, and TDS, because of its strong cash flows, underlying cash flows as an operating company, make this one, um, the green diamond is flashing very strongly in this one.
Yeah. So again, this will make a lot more sense in a couple days. I mean, JD and I are working tirelessly to put together all the pieces in a way that we can actually share kind of the underlying info and all of that behind it. And that'll be coming soon. But for now, we always like to get you started with some free trade ideas out of the gate. I would consider us officially 1 for 1 on opening playbook because T-Mobile is one that we share an opening playbook and it's a beast. And then we've got TDS coming as hopefully 2 for 2. And I gave you 2 different options here. Super aggressive one would be the May 16th. If you get an immediate pop, this is one that you could target triple digits on. A little bit more moderate would be to give it June 20th. It has over 30 days to make a move. And guys, if you have questions about the green diamond and all of that specifically, we will cover those all very shortly. I don't want to get too sidetracked today because even though I love talking about the green diamond and I'm holding my green diamond, today we're not really spending a lot of time on it. I just wanted to kind of sneak peek it because I like
Nathan, we
doing
did
it.
get one question. I'm going to chime in. I know we don't want to talk about it too much, but it does apply to your option recommendations. So what's important? Somebody asked about track record over the last 12 months, and since inception, which is we started or I started doing this in early 2024. We've round tripped some 150 trades or thereabouts. The average gain is on each trade has been right around 5%. And the average holding period, and this is what's important when you establish your option position, is 28 days.
Yeah. So obviously on some of these, if you're going for I guess what you would call maximum potential, you give that option a little more time. If you go for some of these quicker hits like the T-Mobile, you could roll some options if you want to give it more time and go for there's lots of different things you could do just based on where, kind of how you want to approach it. And again, that'll all be more clear very soon. I want to keep showing you guys this chart. This is one of the things that always makes me cautious, even when I'm net bullish overall, is when insider buying is at lower levels. It always makes me nervous that retail frenzy is high, insider buying is low. Normally, that sets you up for more of a quote unquote flush scenario where it's easy to take that retail money and then insiders will step in when there's a more confident floor. So again, it doesn't mean the market can't go up. Please don't get me wrong. The market could rally without this. It did all of 2023 and 2024 while insider buying was actually quite low. And we had a big bullish market. So don't get me wrong. It's just that after big pullbacks, I really like to see this at least step in and say, hey, we feel comfortable with the value of the market. We feel comfortable that it's flushed enough. We're back in on our own shares, on our own stocks. And that's really what this is saying, by the way. If you guys are wondering, why do I care about this? It's an overgeneralization, but it's important. It's basically saying, hey, do all of the guys who know their stocks inside and out, the CEOs, the CFOs, the COOs, do all of them believe, given the current conditions, I feel very good about the upside of our stock right now? And they kind of go in together. And when you see that across hundreds and thousands of stocks, everyone feeling that and putting their own money behind it, it's one of the better indications, especially in kind of market conditions that have been suppressed, that you start to feel more confident about the market. And that's why I always show that chart. It's a great kind of final indication, more so in dangerous markets than in bullish. You're not typically going to get bullish confirmations from this. So let's say we do rally, we make all-time highs, and this never picks up. Well, then you can kind of throw it out the window for the next year until we have another flush, then bring it back out. Okay, just again, so you kind of know the mindset. I do want to give you guys one more earnings gamble trade. Graham is in Hawaii, but I have to pay homage to him as well and give you a Fortinet trade. Graham always likes to talk about Fortinet. One of his biggest trades ever was on this stock. It often overperforms the implied move, and so I'm going to give you this one as well, just as a little earnings gamble. I've been pretty optimistic on earnings overall. I traded EA yesterday. I traded a small size on SMCI. Did an AMD trade. Again, very small size, just looking for some outperformers. And Fortinet is another one that typically fits that bill. And it gives you pretty good risk-reward ratios for how much it tends to move. All right, a couple reminders as I always give you. members, you can email me directly. Please make sure you're in my Telegram to get all my updates, what's going on, what do we do on these free trades, all that kind of stuff. And then just make sure you're on my stock list, um, which is just a text list that you can add your phone number into, and you will get my stock of the day. That is on this page here. Okay, so that's this page here. I'll throw the link in the chat to anyone who doesn't have it, where you just throw your number in here, click yes, and you will get added to that text list where I send a stock of the day. All right, so let's jump into. Oh, I spelled fortress wrong. That's not good. Let's jump into the money fortress. Like I said, I'm going to kind of treat this more as a podcast, I guess you would. I just want to let Jamie kind of talk and hear from him on this idea. JD, if you have stuff that you want to share, I mean, you can take it and share, but I was going to kind of open the floor here because the preface that I have for this is that most people that are on, opening Playbook or one of our sessions are thinking of one-off trades. Thinking of one-off option trades or systems or kind of game things. And what you're talking about is more of a structural approach to, to really build a portfolio, more of a portfolio building approach. And so I guess let me start with the big question. What is the money fortress? What does that even mean? How do you kind of approach that as an investor? Because we're not talking about individual trade ideas, from what I understand. We're talking about more of a systematic portfolio approach.
Well, Nate, thank you for having me here today to introduce the concepts of the money fortress. I would start with, the history, and I've been in the industry for 30 plus years now, and I've really seen it all. I started on Wall Street in no well in the fall of 1987. I took my Series 7 exam on Saturday, October 17th, which was fortuitous, obviously, because the market crashed on that Monday. So um, for a while there, I thought I was just bad luck, but obviously there were market considerations going on at the time. But really, the Money Fortress was born out of a confluence of events and factors. Nathan, one is that most individual investors are woefully prepared for their long-term financial goals. 60% of the country is living paycheck to paycheck. And I believe very strongly that Wall Street is rigged against those investors and traders. And so if you think about that combined with the fact that uh, simple compounding based on the average returns of the market, say 7 or 8%, it would take an investor 10 years just to double their money. And if
Right.
you're starting from a very low capital base, call it $1,000, call it, you know, anything in between, right? Doubling your money, if you're starting at that base when you're, say, in your mid 50s, that's a tough nut to crack. And so in most, you know, cases, when you're looking at that dynamic, your choices are far and few between. You can keep doing what you're going to do and follow the passive investment strategies, which, in my opinion, ask traders to take maximum risk for minimal reward, especially when market valuations are at a peak.
Mm-hmm.
Or you can try to generate outsized returns, but doing that often, implies taking more risk. And that's where enter the money fortress, which it's not so much a portfolio management system. I have a good friend of mine that, joined me on this journey where she has $20,000. She's 55 years old. She's 57 now. She has $20,000 in her 401k. And I thought, well, let's design a program and utilize this money fortress on that lump sum of capital. We are making one trade. The money fortress is about simplicity as well. So if I can make one trade each and every trading day, there are 250 trading days in a given year. And we're targeting 20 to 30 basis points on these trades, utilizing exchange traded funds that exploit what I call arbitrage opportunities. And we can talk about what that looks like. But the general idea is that if you're making 20 to 30 basis points each and every day, redeploying your capital, right?
So just to jump in, because I think this will be one. This will be a stark difference compared to anything that I would talk about. You're talking about you have 25,000. You deploy the whole
I deploy
25,000
100% of that in one macro trade
on the underlying ETF.
on the underlying ETF, correct?
So that's in and of itself, we're talking about very kind of apples and oranges, which is one of the reasons I want to talk about this. This is not a trading system where you risk 1% of your capital. This is putting your entire portfolio in and trying to edge it up every day.
We are trying to take advantage of daily compounding, right? Because so if we can, you don't need you don't need to hit home runs here, you know. And I talked about risk earlier. These money fortress trades, I'm identifying the arbitrage in the pre-market. We're entering the trade at the open no later than 15 minutes after the market opens, and in some cases we're out in 5 minutes.
And what is an arbitrage? I mean,
Sure, sure.
people think of an arbitrage as, kind of cheating the system to get in at one
So,
price and
so
sell the
we
same
we've
thing at a different.
offered the last time I was with you, Nathan, we offered the four pillars of rational trading. Okay, as an ebook that's free, anybody can grab it. Maybe we can put the link in
Yeah,
there. I don't
I'll
know if
put your
you have
Telegram link
it.
because that's the easiest way
Um,
to grab it right in here.
so again, it's a little complex, and I don't want to dive too deep into the weeds, but essentially I believe very strongly that the market is inefficient. And maybe the best way to describe it would be to look at the money fortress trades that we've made this week, Nathan, trading the triple Qs. Okay.
Okay.
So on Monday, for example, the market after a very impressive run up to the 200-day moving average for the major market indexes. And the moving average, I mentioned that because that's one of the four pillars of rational trading. It made sense that you had a significant lower indication for a lower open in the pre-market trading. But at the same time, there was still runway between we crossed over the 50-day moving averages last week, but we still had some room to run up to the 200-day moving averages. And by its very nature, the capitalism is all about growth. It is like gravity. Thing expansion is a very real phenomena.
Hmm.
So you start with that premise, and so when you get these downward opens, that's something that I can exploit. You add into that the fact that our Treasury Secretary was at the Milken conference on Monday morning, and you knew that there was going to be news very early in the day that the momentum of the news, specifically on tariffs, were going to provide and uplift the stock. So, long story short, I thought there was an arbitrage opportunity that we could exploit with the triple Qs. We got in right at the bell
So
and
right around here on Monday.
at the open. We got in at the open on Monday. Um, and within 30 minutes or within the first 90 minutes of trading, we had a 70 to 80 basis point gain. We closed the trade. I don't recall exactly what the gain was. We it's tricky when you're running a service, right? So I gave the alert, and by the time I actually and I am making these trades for my friend that has the $20,000. We ended up closing with a 42 basis point gain. pull up Tuesday's QQQ, and you had a mirror image of what happened on Monday. Once again, futures were pointing to a lower open, and the four pillars were telling me that that was an arbitrage that I could exploit, knowing that Descent, if you've been paying attention to him, boy, does that guy have confidence right now. He's exuding confidence, and the market is a confidence game. And so uh, the fact that Besant was going to be speaking in front of Congress yesterday, well, I thought there was going to be another pop. And in fact, there was, right? You had the market open lower yesterday.
Yeah,
We
here's
got
the
in
open
right
right
at
here
the
at the
bell.
9:30, and then the immediate pop right there.
Yeah, and again, one of I believe this very, very strongly. It's not in your textbook anywhere, but I believe one way you can mitigate risk is by reducing your exposure to the market, especially when we're dealing with lump sums here.
Yeah.
So I'm avoiding all of the overnight risk by
Well, and I think
entering
one
the
of the things that's interesting is exactly that, because normally when you hear someone talk about reducing risk, the next thing they say isn't, but we use 100% of our capital deployed. That's not usually the next thing that comes after risk. But what you're doing is you're kind of creating the windows where that becomes less risky and you know more advantageous. Is you're basically saying, I'm
Right.
not going to
So a
be
couple things there.
2%
When I
drops.
say 100% of capital, I'm not talking about 100% of your net worth.
Right.
I am talking about you're going to allocate a portion of your capital specifically to the money fortress premise, which we have a dual mandate, right? We have preservation of capital is our first mandate. Generating significant outperformance is our second mandate. So if we reach our target each and every day on average 20 to 30 basis points, and just this week, so we did the triple Qs on Monday, we did the triple Qs yesterday, and I'm in the triple Qs once again today.
Mm-hmm.
42 basis points, yeah, Monday 61 basis points, and right now in live trading we're at about 30. Well, when we started recording, I was at 30 basis points. I don't know where we're at right now, but
Probably a couple more. So yeah, so I mean, the idea here is taking risk off the table by avoiding overnights and all that kind of stuff, but also just trying to make your time count in the market. Just basically saying, hey, I'm when there's an arbitrage opportunity, which for you basically means on the fundamental analysis of value side, in the short term, this is the kind of move I think we have. This is the kind of fade
yeah,
or
there.
or
So
gap
so
fill
so
or whatever.
a lot of it's a bit amorphous, and there's no real way to quantify this other than from 30 plus years of experience doing this. I recognize, I spent more than a decade out in Southern California, really got into the whole surfer thing, and I equate trading a little bit to finding these waves of opportunity. You see, I'm in the triple Qs Monday, Tuesday, Wednesday. Today is a playbook that's repeated over and over and over and over. What's the playbook? Well, the Federal Reserve is announcing its interest rate decision at 1 o'clock. As I mentioned before, the nature of capitalism is growth. The hope is part of behavior, right? I call myself the rational trader. Behavioralism is a big part of this, and recognizing stack was significantly higher.
Yeah,
My favorite risk on leading indicator, Bitcoin, was up 3 or 4%.
yeah,
By the time the market opened, all of that hope had faded. Okay. We opened up maybe 10 basis points, got into the triple Qs. And now, as we trade into the Federal Reserve decision, the market is rallying. I just looked at where we're at. We got in at 481.89 on the triple Qs, and I'm sitting at a bid of 483.60 right now.
yeah. So for those ask, what is a basis point? The basis point is that first decimal, that first tenth. So A 1% is 10 basis points, 2% is 20 basis points.
One
Or
1% is 100 basis
or
points.
sorry, yeah, I just went backwards with the decimal. 1% is 100 basis points, 2% is 200 basis points. So I was looking at dollars and saying percentages. So right now the Qs are what are they? 483. We're looking at right here. Hold on, let me move this out. 483. There we
Yeah,
go.
my target today was 484 on the Qs. I would have closed this position if I wasn't doing this. Um, my 484 was an aggressive target. I was looking really today for just hitting my average 20 to 30 basis points. At 484, I would have been up 44 basis points, and I would have, I want to close at that level.
And so the basis points, the reason for that is because it's a true percentage number versus anything else. It gets you into that compounding. Like one way to think about the basis points, normally the Fed will raise rates 25 basis points. What are they doing? They're raising rates a quarter of a percent, right? And so
Correct.
if you think about your portfolio in terms of percentages versus just dollars here, dollars there, that's kind of what gets you into this compounding because your goal 20 to 30 basis points, if you average that every day, you're going to be at like 70% annual ROI, right? Like,
Yeah, at 20, at 200, if you assume 250 trading days in a year, Nathan, 20 basis points is 50%, 30 basis points is 75%
okay,
per
yeah.
annum.
So, 50 to 60%, 70 to 75%. That's the reason that is interesting and I think powerful is because you're once again talking about full allocation. So like I can talk about a lot of income machine trades that do 17% or 22%. Love those trades. But that's a 15% on the 2 grand that I popped into that trade from my account. It makes the compounding of your account a little dicey because you figure out what are all the trades I'm taking, what allocation do they have, how often do they hit, all these things. You're talking about actually grinding out, recycling, I would say, the entire portfolio on these basis points. So when I call it a portfolio strategy, I don't mean a holding portfolio. I mean a growth, like you're leveraging the portfolio.
Correct. Yes. And I should add that, these are goals and objectives, and they're averages, right? So I'm not winning on every single trade.
Of course.
And I often fall short of my goals and objectives, but the you know the dual mandate really is a driving principle. And at the end of the day, if I deliver on the dual mandate, you're going to be way ahead of the game on that pool of capital that you allocate to the money for. It's also meant to be fun, right? I mean, it's a and simple. We get in, we get out. You know, 2025 year to date, I'm up 8.5% right now,
Oh
uh,
wow.
year to date.
So with the market, what I don't even know what the market's down now because the pop it's
Well,
down
year
what.
to date, the Russell's down 10%, the Nasdaq's down 8%, the S&P's down 4%.
Okay. Yeah. And you're trading those instruments directly and you're up 8.5% year to date as they're fading, which is pretty cool. So let's go back and revisit this pre-market arbitrage thing a little bit. I know we can't I know you can't explain everything in one, sitting here, but I think probably the question people have is, okay, I'm starting to get the portfolio thing. You're finding you're going for these smaller moves intraday, using the whole portfolio. You're trying to stack up, not big wins, small, 0.1, 0.2, 0.3% wins. You're stacking those up, you're compounding, all makes sense. So JD, how do I know what to trade? Because conceptually you get it, but how do you actually pick an entry and an exit?
Sure. And again, I simplicity, you know, uh, again, the broader market out there, everyone has their day job or their hobbies or their retirement. They have their lives to live. You don't want to be glued to a screen 24/7, placing these money fortress trades. So, I do the work for folks, right? I'll assess conditions pre-market every single day the market is open. I identify the trade. I send out an alert. with instructions. And again, we're the rules are make this trade at the open between the bell ringing and 15 minutes after the market opens. And from there, it really just depends on. Sometimes we hold the trade for no more than 10 minutes
Hmm.
because we've achieved our objective, and I don't want to take that extra risk,
Right.
of exposure. So I get out.
And for those, I know people can go and jump into Telegram and read the ebook, obviously, but what what is the shortest version of the four pillars that you're looking at that you can give here to say like these are kind of the macro things weighing on that
Yeah, I
pre-market
think the
decision
beauty
making?
of it is again in keeping, a KISS, right? Keep it simple, stupid, and I try to do that. Uh, the four pillars are simply macro indicators. I'll share them with you here. The yield curve is hugely important. It's funny watching, the executive branch, whether no matter who's in the office, trying to take credit for the economy is probably the biggest joke in on Wall Street, right? I mean, it's silly. Um, the Federal Reserve controls what happens in the economy, not the executive branch. Period. End of story. Full stop. So the actions of the Federal Reserve are expressed by the bond market, and the bond market determines interest rates. So the yield curve is simply a comparison of the 10-year yield to the 2-year curve. In bull market conditions, you have a gently sloping, upward sloping yield curve. And if you don't, uh, well, then that's a variable that you factor as one of the four pillars into identifying how markets should be trading based on what you have in the yield curve. The other pillars are the technical, or one of them is technical. Uh, the moving averages. We talked about the major market indexes are now trading between the 50-day and 200
Mhm.
That's important data. So I need to incorporate that into finding my arbitrage opportunity. Valuations are hugely important. So very simple PE ratios on the major market. So the S&P is still trading around 20 times. That's very high, right? Um, so the I had a valuations professor in graduate school, that had us all do a homework assignment that lasted, it was 1 to 2 weeks of work. And I think I was analyzing American Airlines, Nathan, and
Mhm.
so proud of my, it was a report this thick. And, we all 15 of us brought it into the professor, and we handed the reports onto his desk and sat back down, and he took all of those things on his desk and he pushed them into the garbage can. And he said, the value of a stock is the price somebody pays for it.
Oh my
And,
goodness.
that was 1993 when I attended that lecture, and I remember it like it was yesterday. And so that's seared into my brain, and so valuations, even though they're high, doesn't necessarily mean that they're going to be low. And the fourth pillar is the volatility index, right?
Mhm.
So that's hugely important as well. So I take all of those four pillars and I use it to triangulate a forecast. And if the market is trading different from my forecast, that's how I find arbitrage.
And okay, makes sense. Okay, so basically, if for the arbitrage is your forecast versus the present value, and you look for kind of a gap fill between those two realities, what you project and where the market is at the moment, and obviously some of these days you're going to be flat wrong. So what do you use a stop loss? Do you use a certain basis points on the other side?
Yeah. Nope. If I'm wrong, I use my rules, which is exit before the end of the trading day. So if I'm wrong in the at the beginning,
Hmm.
then I I have the rest of the trading day to be right. Now, if I'm in an aggressive position, trading off of volatility, for example, or there are tricks of the trade that I've learned over the years too, right? Like there are specific conditions that are very, very fertile to utilize leverage. Okay.
Hmm.
So I'll use, like a triple Q ETF. And if I'm wrong, I'm going to get whacked.
Right.
But uh, again, I'm not wrong very often. I don't know how to say it other than
Well, again, I mean, if you have a perceived value of something and you're trading it when it's kind of at the other end of that value, it essentially maximizes risk reward. I don't want to overgeneralize it, but it's like your trade on T-Mobile. The reason T-Mobile was a good entry wasn't just because you thought it could go up. It was because you thought it could go up and it had already overexposed itself to the downside. So you'd kind of gotten
that's right.
a better value relative. And so when you do that, like especially how resilient the market's been, you know, gap down have been rallied like 80 some percent of the time since that March 20 low or whatever. And we saw that, by the way, all in 2024 when the markets were bullish. That there's so much resiliency and buying pressure in those
Yeah,
situations.
yeah. You make a really good observation, Nathan. And if I can bring in some statistics and probabilities are massive. So I'm using expected values. I talk about a forecast, and I
Hmm.
really try to just see what's right out in front of me. I'm not looking at what's going to happen 14 days from now. I'm looking at what's most likely going to happen today
Hmm.
when the market opens. And a couple things there. You mentioned T-Mobile. Well, one of the uh, cool things about the green diamond is that we're incorporating something called standard deviation. And a stock will trade in between two standard deviations below or above the mean 95% of the time. So if you're outside of that and on the downside, if you are underneath that level, the odds are greatly in your favor for the stock to revert back to the mean.
Yeah.
And that's another way that you can mitigate risk, isn't it? I mean,
Well, like I said, if you want to buy something at a certain price, you have a certain amount of risk. As soon as it goes down, you objectively have less risk, right? Especially relative to the perceived value. So, I, you know,
well,
it.
look at these triple Q trades. So the Nasdaq was opening down 100 basis points on Monday and Tuesday,
Hmm.
1%.
Hmm.
Okay, I mean, just rationally speaking, uh, does it make any? I mean, what on earth changed to make the market worth 1% or 2% more or less on any given day?
Yeah.
In other words, you don't you, the variability of the market swings. It's very unusual to have a market down or up triple digits. So if you know that fact, and you can, again, with the NASDAQ down 100 basis points, the odds are in your favor for the market to revert back to the mean.
Yeah, I mean it's kind of like all the different statistics you hear. You said that the deviations one, which I think is very powerful. The percentage of stocks that fill gaps, all these different things, they're all kind of saying the same thing that when values change much too quick for reality to catch up, then they have to kind of backfill closer to a, a reality that people are willing to accept. And so one of the things that I think is fun and cool to talk to you about is that really your approach is quite different. And we'll talk about this on Monday a good bit more. But one of the things that you do that really I don't do hardly at all, and most of us don't, is this idea of blending the fundamental value, the macro analysis, into active trading decisions. And so that's quite unique, I think, in what people will really enjoy about some of the stuff that we talk about, with the Green Diamond and the Money Fortress obviously plays as well, is that component, that kind of force behind where we expect opportunities, not just because something crossed on the chart or even just because of a standard deviation, but kind of the macro valuation layered on top of that, that shows when something technically looks attractive, it's exponentially more attractive if you have a kind of a perceived or a forecasted value on top of it. So I think that's kind of what makes everything you're talking about unique, is that layer on top of it that, really, like I said, I don't look necessarily at that. Most of us don't. We're pretty systematic in nature. And so I'm pretty excited to talk about that a lot more in detail on Monday and kind of as we go along, because I think people will see really the difference between when you have that engine kind of revving behind a stock versus when you don't.
It's interesting, Nathan, and I appreciate what you're saying, and thank you. I we have spoken previously. I don't know if I shared this with the audience, but I really uh, this is the everything that I'm doing is the culmination of many, many, many years of work, analysis, and experience. And I just to share, if I can, a little bit. Now 5, 6, 7 years ago, I had been working with another publisher and really just had a it, you if I told you you'd say you can't make that stuff up. It was such a bad experience, and I'm just an unassuming guy here in the Midwest with farmers' values, and Wall Street is a tough place, and I get that. And business is tough, and sometimes bad things happen to good people. But after that experience, I found myself wandering in the desert to a certain extent, and I had this epiphany that all of these years of being a fundamental analyst was bringing me to this vision of being a bridge between investors and traders, that all of this wealth of experience could translate into something that I developed into this trading system that we've with your assistance, Nathan, have created this green diamond. It blows my it literally blows my mind.
Yeah. Well, I think that's a good place to leave it, JD, because we can't give away too much. We promised our people we'll save that, but hopefully just them hearing kind of the Money Fortress fundamentals was a good, like I said, meat and potatoes, kind of how you look at things. Several of you asked about like the four pillars that Jamie talked about, trying to get evaluation for then what he's arbitraging against. Guys, that's all free in his Telegram. So you don't have to guess what the four pillars are or what he's looking. He has an extensive ebook pinned in that free Telegram to give that away. So that's not meant to be a carrot that you can't understand. That's meant to be value for you to read and understand. And if you do understand the four pillars, then you'll understand a lot of what JD shares. Why he's contrarian in some ways and not in other ways, because his framework kind of stands alone as he forecasts these values. It's not based on always what earnings are doing or always what this. It's really his own concoction of value estimation. And like you said, he hasn't been wrong very often on that, even in these short terms, which in these markets is pretty cool. And then really, I mean, what gets me excited, because I'm a trader's trader and I love the active, the big potential side, is kind of parlaying that into the green diamond idea of finding these individual specific stocks that have outsized opportunities, applying timing to that, applying options, all that good stuff. For me is obviously really, because I'm not a portfolio guy. I mean, I have a portfolio, obviously. I manage it. I want it to do well. I would love it to make 50% a year. Don't get me wrong. That's where the majority of my capital is. But what I spend, late nights into 1 and 2 and 3 in the morning on my laptop is kind of the systems trading side. And so blending that together, one more time for you all at home, the Green Diamond idea is very exciting to me.
Look how
So
sparkly that is.
yeah, it is. And it'll all make sense. I promise. We're having fun with it, but it'll all make sense. So yeah, JD, hopefully people got to know a little bit of your background, a little bit about how you see the world, because it is quite unique. And we'll obviously be backfilling lots more information in the coming days over the weekend, and then really
And
on Monday.
just to show you how much I care about you, my trade today now is gone underwater. So I missed my exit, but oh well, it was worth it.
Yeah, that is one of the things I've found about being live a lot more often. Sometimes you have to sacrifice some of your own trade management to hopefully help others. It's happened to me more than once. But fingers crossed we'll get a little pop back here. But yeah, I appreciate you guys jumping on as always to the opening playbook. Hopefully it was another valuable session today. We actually probably will not be live tomorrow. I think we'll miss our first opening playbook here in the last couple of weeks with Graham still in Hawaii, and I have an engagement. So I think we will end up missing tomorrow, but be back live Friday at 10 a.m. So in the meantime, guys, grab that free Telegram report. It's just Jamie's name right there that I posted in there. It opens up an app, the Telegram app where you can join the channel, and then you should just find his report pinned in that channel that you can read. And of course, most importantly, keep an eye out for our updates over the next couple of days, because we've got a lot of stuff we're working on that's coming to a peak here. And I sure hope that everyone is able to join us for that. Perfect. Thanks, everyone. See ya.
Thanks, Nathan.